In this video, I'm going to cover the content of financial terms and calculations, which is part of GCSE Business AQA. So what are costs? A cost is anything that a business will have to pay for, and those costs will need to be paid regularly. For example, rent, bills, raw materials, postage. Costs are split into three main categories: fixed costs, variable costs, and total cost. What are fixed costs? So fixed costs are costs that do not change. No matter how much output the business makes, these costs will stay the same. Now, these costs will be fixed for at least a year or more, which means that a business will pay the same amount of money either each month or each year. For example, rent, salaries, insurance. Variable cost. Variable costs change depending on the amount of output that a business makes. So if the business is selling or making more products, then these costs will increase. If they are selling or making less, then these costs will decrease. For example, wages, postage, and raw materials. Total cost. Total cost is the total of fixed cost and variable cost added together. So total cost is fixed cost plus variable cost. How to calculate revenue. Revenue is the money that a business makes from selling their products or services. Businesses will need revenue to ensure that they can meet their day-to-day costs and operations. The formula for revenue is selling price times by quantity sold. So for example, if a florist sold 300 bouquets of flowers for £5 each, their revenue would be £1,500, which is 300 times by 5. How to calculate profit or loss. Businesses measure their success based on how much profit or loss they have made. So profit is the revenue that is left after all costs have been deducted. So profit is revenue minus total cost. If the cost of the business is higher than the revenue they have made, then the business is making a loss. So an example of profit or loss. So if a business has a revenue of £40,000 and their total cost is £31,000, then their revenue will be £40,000 minus £31,000, which is £9,000, which means they're making a profit. However, if a business has a revenue of £20,000 but their total cost is £35,000, then their revenue will be £20,000 minus £35,000, which will give them minus £15,000, which means that they are making a loss. How to calculate average rate of return. So businesses often have to make investment decisions, which might be which equipment to buy or if they should invest in a new building. Any investment made will have the hope that in return the business might be able to make some profit from it. So a business will need to know the potential return they can get from investments, as it will allow them to know if the return is better from either leaving the money in the bank or if they should invest it in the investment. The calculation that can help businesses compare the different investment options is average rate of return. The average rate of return compares the profitability of different choices over the expected life of the investment. It compares the average annual profit of an investment with the initial cost of the investment. So in order to calculate the average rate of return, a business needs to first calculate the average annual profit, which is total profit divided by number of years. Then using that, they can calculate the average rate of return, which is average annual profit divided by the cost of investment times by 100. How to calculate break-even. So break-even is when the total revenue and the total cost of the business are the same, which means that a business is neither making a profit or a loss. The break-even level of output is how much products a business needs to sell in order to reach a break-even point. So to calculate break-even is going to be fixed cost divided by contribution per unit. And to calculate contribution per unit is going to be selling price minus the variable cost per unit. So how to calculate break-even? Here's an example. Amy is making biscuit boxes. Her fixed cost will be £100. Her variable cost will be £5 per box. She's going to produce 50 boxes. The selling price of the biscuit boxes will be £10. So again, break-even is fixed cost divided by contribution per unit. And to work out contribution per unit, it's selling price minus variable cost per unit. So it's going to be 10 minus 5, which means the contribution per unit is 5. Then the break-even is the fixed cost, which is 100, divided by the contribution per unit, which is 5, which means that the break-even is 20 biscuit boxes. Now, a break-even graph. So to first draw a break-even graph, you're going to need the output and the cost or the sales. Then you'll need the fixed cost line, which will stay the same regardless of any output made. Then will come the variable cost line, which means as output increases, the variable cost will increase, and the total cost line as well. After the total cost line, there will be the total revenue line. And when the total revenue and the total cost line cross, that's the break-even point. Margin of safety. The margin of safety is the amount that sales can fall before the break-even point is reached and the business makes no profit. So the calculation tells a business how many sales they have made over the break-even point. The larger the margin of safety, the lower the risk for the business. So to calculate margin of safety is actual sales minus break-even sales. For example, a business has break-even of 100 products and has sold 150. So the margin of safety is 50 products. This is a break-even analysis advantages. So it shows how many products a business needs in order to sell or make a profit. In order to sell to make profit. It shows a business if a product is worth selling. It shows whether costs need to be reduced in order to lower the break-even point. It can be used to persuade the bank or investors. It is a quick and easy way to analyze. What are the break-even analysis disadvantages? So break-even assumes that a business will sell all their stock for the same price. Businesses can be unrealistic with their calculations. Variable costs change constantly, which could make it unreliable, and it can be time-consuming to create. Hopefully this video helped you understand financial terms and calculations. If you like this video, then give it a like and subscribe to my channel. If you want regular updates on resources and videos, then follow my Instagram. If you want business revision clips, then head over to my TikTok. And if you want this PowerPoint, then head over to my test shop.